In this video, I'm going to share with you 5 of the biggest mistakes people make with money. This is going to help you identify and avoid these costly mistakes so you can in turn make better decisions. They're going to help you get more out of your money and more out of your life. Not having a clear vision means not setting goals or not clarifying what you value in life. Without a clear vision, you're going to do one of 2 things. You're either going to not take much action or you're going to just do things without much thought or much method. That might mean my friends are buying investment properties, so I'll buy investment properties as well. That is not a good strategy. Good decisions are aligned to what you value, both the small day-to-day ones and the big ones, like should we invest? Should we buy a bigger home? Should we put our kids through private schooling or should we travel the world with them? Having a clear vision for what you value, it's going to create filters for your decision making. And the better you can be at aligning those decisions with what you value, the happier you're going to be. It's the natural consequence. Are you spending everything you earn? Are you making great money but not making great progress? We all know people making this mistake consistently, even for decades. Getting your cash flow right, it's foundational. Trying to get ahead financially with poor cash flow, that's like trying to build a house on sand. We all know that's not going to work. To avoid a mistake, you've got to know why it's happening. The why here is simple. It's a lack of discipline. It might sound harsh, but it's true. And the sooner you get to the truth, the sooner you can do something about it. And the good news is, doing something about your cash flow is not complicated. We think it takes 2 things. One is commitment, the other one is accountability. You need to commit to what you want to achieve and by when, and you need to keep yourself accountable. And the best way to stay accountable when it comes to your cash flow is to automate your cash flow. Not all investments are created equal. You can't just invest in any shares or any property or any business and expect to do well. But this is unfortunately the strategy most people take to choosing their investments. I call it hit and hope. There ain't much method to it. They end up buying apartments off the plan, getting involved in the wrong developments, having a couple of shares and thinking that's a portfolio, getting into speculative things like cryptocurrency, or putting money into a dead-end business. The crying shame is that the investments you choose is going to have such a huge effect on where you get to financially. Over a 10, 20, 30-year period, it can be the difference between financial freedom and not. So why does this happen? First and foremost, it is just a lack of knowledge. People don't have the expertise and the information to make informed, rational investment decisions. People instead form these overly simplistic views about investing, views that tend to come from the people around us, quite often our parents. Views like all property goes up. If that's a belief that you have, you're not going to put the time and the energy into educating yourself to be a great property investor. And I can tell you that over the long run, that is going to cost you a lot of money. These overly simplistic views, they lead to overconfidence. And just like kids that are overconfident, they get hurt. Adults that are overconfident financially when it comes to choosing investments, they get hurt. If you don't have the knowledge to invest well, you either need to acquire it or you've got to call in the people that have got it. If you've bought the wrong assets in the past and you're still holding on to them, you need to make some difficult decisions in getting rid of them. And that is not easy. It is not easy to admit that you've made a mistake. Buying is easy, selling is hard. But often it is just a choice between protecting your feelings or protecting your finances. We've all heard the concept, buy low, sell high. Now that sounds simple in theory, but in practice it's super difficult. And most people, in fact, they do the opposite. They buy high and sell low. And this is done so consistently, there's actually a name for it. That name is the behavior gap. And it refers to the fact that people's behavior as investors costs them a lot of money over the long run. Now to illustrate, for the average investor that buys the ASX 200, that's the 200 largest companies on the Australian Stock Exchange, they will erode about one third of their investment returns over a 20-year period. Now the reason they do that is they react to markets, and that reaction typically is by buying high and selling low. So why do we do this? The reason is simple. We're emotional creatures and we make emotional decisions and we make emotional investment decisions. But market timing shouldn't be about emotion. It should be all about the numbers. People get overexcited on the way up and they get that FOMO thing going on. both in shares and in property, and they panic on the way down. When you've worked so hard for what you've got invested and it's falling quickly, that's terrifying. And at the very least, it's stressful for people. You need to understand that the fundamental challenge of investing is actually making good decisions in difficult times. If you can do that well, you will invest well. Too many people pay too little attention to their super. We feel disconnected from it. We can't connect our future selves to money we're going to maybe come into decades down the track. The system's complicated, the rules change, and most of us don't understand the investment side of things anyway. Setting all of that aside, 9.5% of everything that you earn while you're working, and soon to be 12%, is going into your super. So you need to make the most of it. So what does not neglecting your super actually look like? It could be consolidating funds, moving to a lower fee fund, but these are not the most important things at play, despite what the advertising might be telling you. The most important thing you can do in taking control of your super is what's called asset allocation. And that's a bit of jargon for what am I investing in? Am I investing in shares, property, cash, bonds, and in what combination? What you invest in is going to have the biggest impact on what your investment returns are over the long run and what that balance looks like come retirement. It's also going to have the biggest impact on the ups and downs of those returns over your journey. That can also be called volatility. If you're not yet in your 50s or your 60s, you should be investing your super virtually solely in growth assets. Growth assets are shares and property, and they're growth assets because that's what they do over time. They grow in value for you. The opportunity cost of not doing this and not paying enough attention to your super is huge, and it could easily cost you hundreds of thousands over your working life. That's it. There's 5 of the biggest mistakes people make with money. Avoiding them is so important because your financial progress is as much defined by what you get wrong as it is by what you get right. And just a few significant mistakes on your journey is really going to hold you back. It's going to hold you back from getting ahead financially, but more importantly, it's going to hold you back from getting the things that you value in life. Family time, freedom, travel, educating your kids, giving to others, things more important than money, things that really matter.